After quite a long period of underwhelming performance, UK stocks have performed pretty well over the past year, with an accumulating FTSE 100 ETF being up over 10%. This past year also flatters a 5-year chart, and I was pretty surprised to see that a FTSE 100 ETF is actually currently matching the returns of a global index tracking ETF over this period. Not something I would expect to see. Now, to be clear, there's no way of knowing for sure how UK stocks will perform going forward, but it is a sign that maybe they deserve a closer look. Whilst I'm mainly an investor into diversified funds myself, I do find looking into individual UK stocks super interesting. And in this video, we're going to look at a list of 10 of the top UK stocks as of July 2025 put together by Stockopedia. These stocks are drawn from most of the major economic sectors to offer basic diversification principles, with factor-based rankings and earnings momentum filters also applied. Regular viewers will know I'm a big fan of factor investing, and it is exciting to see what 10 UK stocks currently rank highest when such criteria is applied. And as fellow investing enthusiasts, I thought you'd all be interested to see this list too. There's some names you certainly wouldn't expect. And whilst there's never any guarantees of future results, the 10 picks from last year have now returned over 25% when equally weighted, which perhaps serves as evidence of the strength of applying factor investing to stock picking. This video has kindly been made possible by the sponsor, Stockopedia, the UK stock analysis and research platform that applies a research-backed system and helps you make more informed investment decisions. This video is not investment advice or hot stock tips. It's to explore the application of factor investing, identify stocks that could be candidates for further analysis, and act as a research prompt. It is certainly not a recommendation list, and investing into individual stocks will of course carry more risk than investing in a well-diversified fund. As always, you must do your own research before making any investing decision. Now, before we dive into the list, it's important to frame why stock picking is so difficult and what we can potentially do about it. One of the best articles to help us show how difficult it has been to pick winners is Hendrik Bessenbinder's 2018 paper, Do Stocks Outperform Treasury Bills? It is for the US market, so US focused, but it is still helpful nonetheless. The key takeaway is the skewed distribution of stock market returns. Only a small percentage of stocks drive the long-term market gains. When stated in terms of lifetime dollar wealth creation, the best performing 4% of listed companies explain the net gain for the entire US stock market since 1926, as other stocks collectively matched Treasury bills. That's pretty shocking. So this explains why picking individual winners is so difficult, because there's so few of them. And it also explains why diversification is so critical. Missing out on a few key stocks can massively impact your returns. Simply put, the distribution of individual stock returns is positively skewed. Large positive returns of a few stocks offset the more modest or negative returns of your more typical stocks. I wanted to mention this before we dive in because it's always important to remind ourselves of how difficult it is to find winners, and we shouldn't delude ourselves of thinking that it's really easy to find the hottest stocks or we should trust what some guru on social media tells us. If we're just picking stocks based off hype or a certain story, we're probably not going to have success over the long run. I won't go much further into this topic as I am planning another separate video to dive into Bessenbinder's research, the Spiva scorecard, psychological biases, and a lot more things to talk about when it comes to the difficulties of picking individual stocks. But it's important to establish that context before we dive in. I personally have the majority of my portfolio into ETFs and investment trusts because I believe in the benefit of diversification. However, if you are going to pick individual stocks for a large part of your portfolio, of course, diversification remains important, but there needs to be some sort of process or system in place to help you increase your chances of picking winners. After all, the reason we would try and stock pick is to try and find those winners. Our biggest enemy as investors is ourselves, our psychological temptation to buy, sell, listen to news, all these things distracting us. But having some sort of system or process and trying to get away from that emotional behavior is probably a good thing. To summarize, if individual stocks were going to be a big part of my portfolio, I'd find it essential to have the following: applying a consistent research-backed process, minimize my emotional decision-making, that is very tricky. Try and avoid hype-driven ideas and story stocks, which is especially hard in an age of social media when you have so many creators pumping out videos on a different stock each day. And finally, to reiterate, it's super important for me to say this again, the importance of diversification. Individual stocks can plummet in value no matter how much research you do on them. It's important to have diversification so not all your eggs are just in one basket, as that can be catastrophic. So, if stock picking is so hard and the odds of picking winners are so low, What can we do about it? One approach that has gained a lot of attention in research and what I talk about a lot on my channel is factor investing. I talk about it a lot because I find strategies that are research backed to be more compelling. Rather than picking stocks based off a gut instinct or what we think will go to the moon next, employing factor investing involves looking at characteristics that have historically been linked to better long-term returns. We're talking about things like profitability, valuation, and momentum. Nothing is perfect, but it gives us a potentially repeatable, evidence-based framework to work with. And that is exactly the approach Stockopedia takes with their stock rank system. We have three main factors that are applied. Quality: is the business strong, profitable, and financially sound? It seems pretty sensible that profitable, quality firms beat junk. Value: are the shares underpriced relative to earnings, sales, and assets? Put simply, cheap stocks have outperformed expensive stocks historically. Momentum: is the sentiment improving in terms of share price and earnings? Winners tend to keep on winning in the near term. These factors are all underpinned by both theory and practice by famous investors, as you can see on this chart here for the quality, value, and momentum factors. And in particular, Farmer and French are down in the value area here, but they have also done work on profitability, so they have contributed towards the quality theory as well. I've covered this more in another video that I'll also link in the description. So with these factors, Stockopedia analyzes the financial data to create a rank out of 100 for all three every day. These ranks are then blended into one overall stock rank as well. To take a quick look at how these ranks are measured, quality is based on quality of franchise, so things like long-term average return on capital employed, gross profit to assets, long-term sales growth consistency to name a few, fundamental momentum, and bankruptcy and earnings risk. Value is measured on earnings ratios, so like price to earnings, earnings yield, price to free cash flow, and price to sales, asset ratios like price to book value, and income ratios like dividend yield. And finally, momentum is measured on price momentum, so things like relative strength, and also earnings momentum, so EPS estimate upgrades, EPS surprises, scaled earnings surprise, and consensus broker recommendation upgrades. So I do like the combination of both price and earnings momentum here. And what Stockopedia have found is that high-ranking shares have significantly outperformed the market. For example, as we can see here, the highest-ranking UK shares have massively outperformed the FTSE All-Share Index. The outperformance is most notable for small caps, but even if we change the filters to only include stocks with market values of over 350 million, you can still see a very noticeable outperformance over the market. And to me, this is quite compelling evidence that a factor-based system has worked, particularly in the UK market. Now, it is important to remember that this isn't some sort of miracle framework. Of course, there is still losers among the high-ranking shares, but it has increased chances of picking winners, as we can see from this hit rate chart here. 0 to 10 ranked shares have had a 25% chance of being a winner, whereas for 90 to 100 ranked shares, they've had a 63% chance. So it is clear that filtering out the junk, expensive, low momentum sections of the market has improved chances of success. If you'd like to give Stockopedia a try and make the most out of the stock reports, the stock ranks, the active community, and many more tools, you can get a 25% discount off your first subscription by signing up through the link in the description, or you can use the code TP25 at checkout. I'll also put a QR code on screen for those watching on TV. You also get a 14-day free trial and a 30-day money-back guarantee, so you can't go too wrong by giving it a try. Thank you to Stockopedia for sponsoring today's video. So now that we understand what the stock rank system is and how a factor investing strategy might improve our chances of success, let's have a look at what the top 10 UK stocks have come out to be. Remember, these are not recommendations. These are companies that have scored highly on quality, value, and momentum criteria, and they also have strong earnings momentum at the moment. What's really interesting about this top 10 is that 8 of the 10 major economic sectors are represented in the list. So it's not overly concentrated in one area, and we are getting some diversification. There's also a mix of small and mid caps, and 6 out of the 10 companies have recently had trading updates saying they're ahead of expectations, which is always nice to read, and it is a sign of strong tailwinds behind these businesses. I'll now run through the full list and then pick a few to take a closer look at. I'll leave a link in the description as well so you can download and get access to this yourself for free. The top 10 are Currys, Frontier Developments, Hikma Pharmaceuticals, Journeo, McBride, Morgan Sindall, Plus 500, Ramsdens, Seplat Energy, and Sarabi Gold. So I'm sure there'll be some surprising names on this list, as well as ones that you've never heard of, because obviously with some small caps, it is less likely you'll heard of them. The first one I want to take a closer look at is Currys. This was a surprise to me, and it's not a name I'd expect to rank so highly, because I do have a lot of psychological biases with some of these picks, And that's kind of the point. When you employ a strategy like this, you are going to end up having psychological biases against some that score highly, and it doesn't seem right in your head. When I think of Currys, whenever I've been there, it doesn't really seem very busy, and I never really use it myself. I always go have a look in the shop and then end up buying something online from a different retailer instead. But that's just my experience. It's anecdotal, but it's just an example of how we can have psychological biases against these stocks. Stockopedia note that the past year has been an impressive turnaround story, with full year adjusted profit before tax expected to come in at 162 million, up 37% year on year. Looking at the stock report, the first thing that stands out to me is on the chart where we can see the recent performance. And it is interesting to see that Stockopedia has had it as a high stock rank for quite a while now. It has captured a lot of that upward momentum. So back in early 2024, it did have a high stock rank, and if you'd held it since then, you would have doubled your money essentially. Looking at the financial summary, something that is quite scary for me is that they have recently come out of being highly unprofitable with a minus 481 million loss in 2023. And whilst we are seeing a turnaround, it does kind of show the difficulties that retailers have had in recent years. And if we go down to the operating margin, this is another example of how this sort of business can flip at any time. An operating margin of only 2%, there is not much room for any errors here. The dividend chart does show that the history is pretty patchy in line with their performance, with a dividend cut after the January 2023 dividend, but it's good to see the dividend has been reinstated, which could be interpreted as a positive sign. And finally, for what it's worth, analysts do have it down as a buy, and it has a price target of 142p. The next one I'll take a closer look at is Frontier Developments, with a market cap of £121 million, so certainly a small cap. It's a Cambridge-based video games developer, and this is another one for me that I would have a psychological bias against, because when I think of a small cap video games developer, I'm immediately thinking that their performance is going to be entirely dependent on the success of the games that they release. And with video games, things can change very quickly. If something becomes a trend, there's some famous YouTubers start playing it, they can get some strong momentum and get a lot of sales of a particular game. On the other end, if a game comes out, it has bad reviews, no one really plays it, it could be a complete flop, and then they spend all that time developing that game and with no results. So it does seem like a very risky industry to me. Stockopedia note that profitability has bounced back sharply from adjusted EBITDA of 0.9 million to 8 to 9 million pounds. Net cash has also surged, and there's a proposed £10 million share buyback. As I just mentioned with my biases here, I completely agree with the bare points that Stockopedia have raised here. Game launches do remain hit-driven, and you always will have that uncertainty about how they'll perform. Unlike a consumer staples business that have got products that are just always going to sell regardless of what's happening, that is certainly not the case with a video games company. It's kind of the complete opposite. The financial summary does show that their net profit has been a bit all over the place, so another indication of how volatile this industry can be. Saying that, the balance sheet does look healthy, and they have a net debt standing at minus £6.83 million. There's no dividend at the moment and no history of a dividend, so it's not a company that really cares about paying out a dividend. However, it is important to remember about the proposed share buyback, and that is another way of returning value to shareholders. For this one, if you are going to pick it as an individual stock, it is something you obviously are going to have to do a lot of research into, understand the industry, understand the sort of games they release, whether they're going to be popular or not. For example, I've had a quick look at upcoming releases, show that they do have Jurassic World Evolution 3 coming out in October. I don't know anything about that game, but maybe you do and know that that might be a big success. So things like that is what you need to look into if you are going to have it as like a conviction pick rather than part of a diversified portfolio. And then the last stock from the top 10 I wanted to take a closer look at is Ramsdens, the high street player known for jewelry retail, foreign exchange, and then most importantly in this case, buying gold. Given how the gold price has surged recently, I thought it'd be super interesting to take a closer look at this one. And before we jump into Ramsdens, just a quick caveat to look at a gold ETC to show how much gold has surged over the past year. We can see on a 1-year chart, this physical gold exchange traded commodity is up by over 30%. Then if we go to 5 years, it's up by 67.39%. So it does really emphasize how much of that 5-year return has come from the past year. So unsurprisingly, Stockopedia do note that this has been a big driver, with their precious metals gross profit up 53%. However, other bits have been strong. Jewelry retail profit growth also up 18%. Pawnbroking delivered steady growth. Loan book volumes were flat, but repayments improved and gross profit rose 11%. A look at the financial summary does show a nice trend of increasing revenue and profit since 2022. And the valuation does seem quite reasonable at a modest forward price to earnings of 9.62. In terms of dividends, we can see a nice trend of DPS rising since 2022 in line with their performance, and the forward dividend yield currently stands at an attractive rate of over 4%. Now, in terms of bear points, obviously, the key thing here is the gold price. If the gold price has a big correction or drops significantly, then I'd be surprised if Ramsdens isn't also negatively impacted. Like Frontier Developments, it is also a small cap, and there's always extra volatility and risks associated with them to consider. And I will talk more about that very shortly in the risks and things to consider section of this video. Okay, so that was a quick look at 3 of them in a bit more detail, but switching back to the full list of 10 now, we can see that the quite high ranks that they all have, with stock ranks ranging from 89 to 99. You can see in the sector column here that key diversification across sectors. We've got technology, consumer cyclicals, defenses, basic materials, financials, energy, healthcare. So yeah, diversification, a lot of different areas covered. The stock rank styles are also pretty interesting. I'll put up the chart here that shows the difference between them, but super stock is a stock that scores highly on quality, value, and momentum, and a high flyer is one that scores highly on quality and momentum, but the value score might be a bit low. And with these 10 picks, we've got a mix of super stocks and high flyers. The last thing I want to mention whilst we've got them all listed here is market cap. Now, it's important to remember that a few of these are small cap stocks, and when we look at small caps, bid offer spread can be a very significant cost of buying. So, for example, some of these might have bid offer spreads of 200 to 300 basis points, so you can be 2 to 3% down immediately after buying, and that is normal with small caps. So what that means is you need to be careful when rebalancing too often. If you're constantly buying and selling small cap stocks, you're going to incur a lot of costs, a lot of hidden costs, not costs charged by your broker, just part and parcel of participating in the buying and selling of small cap stocks. And speaking of spread, brings us nicely on the risks and things to consider. So for small caps, unfavorable bid offer spread and heightened volatility are to be expected. Another risk to consider is some stocks may score highly due to current macro conditions, for example, the price of gold surging. And if this does not persist and things move downwards, then obviously that could have a negative impact on some of these stocks, particularly Ramsdens and Sarabi Gold. And for me, the most important thing when it comes to stock picking is the importance of diversification. No matter how good a stock looks, I personally could never go all in or have a significant part of my portfolio in any one company. It's just asking for disaster and catastrophic losses. Yes, concentration can build wealth, but it also can destroy it. And for me, the risk and reward of having a super concentrated portfolio is just not worth it. Even stocks that seem solid, they score highly on all the rankings, all the fundamentals look super strong, the momentum is great. You just never know when some poor result or some market trend or some macro condition is around the corner that just causes it to have a massive crash. You just never know with individual stocks. So yeah, importance of diversification and knowing what you're getting into is just the bedrock of individual stock picking. I hope this video was interesting. Let me know your thoughts in the comments below, and I'll leave the link to download the document so you can look at the top 10 yourself in more detail in the description. Thank you for watching.